Morning, ladies and gentlemen. A very warm welcome to CapitaLand's full year 2019 financial results briefing. First of all, I'll address the people here. Thanks for being here despite concerns of COVID-19. And I know many of our guests are also joining us through webcast. Please say hi by clicking the post question tab. In fact, you can already start depositing your questions. So we released our financial results for full year 2019 this morning. I hope, like myself, you would agree that these are first signs that we've made the right steps. We started our transformation journey in 2019. And in just a few minutes, I'm going to invite our Group CEO, Mr. Lee Chee Koon, to address us. Our Group CFO, Mr. Andrew Lim, will also take us through the results and followed by a Q&A with the senior management team. But just before that, I would like to share with you a short video of our 2019 milestones. Please watch. Chee Koon to address us.
Thank you, Grace. Morning, everyone. Thank you for taking time to attend the briefing this year. I'm going to keep it short. As usual, I'll leave Andrew to go through the details with all of you. 2019 has been an amazing year, as you have seen on the video. Started, of course, with the merger with Sanders Singbridge. That's really signaled the start of a strategic shift for the company to become a more global and more diversified platform. Again, just to remind everyone, our strategy is a very simple one, really about focus, about scale, about balance, about agility. So everything we do revolves around real estate. It's about building scale, making sure that we can be competitive. It's about balance between the emerging markets and the developed markets across different asset classes and maintaining the agility to be able to take opportunities. Business model, simple, really revolves around the word value, how we find value, how we create value, and how we unlock value. So everything that we have been doing really revolves around our strategy and our business model, whether it's the way how we have taken time to remove non-performing, non-core assets from our portfolio last year. Assets that wouldn't make a significant difference nor contribution to our bottom line or to our competitiveness, whether it's our store hub portfolio, our investments in CCRE, there was a listed vehicle in Hong Kong last year, our stake for a piece of land in Kazana and a few others. So we're very focused on that. In terms of our fund management, you see how we have put AHT and ART together, how we have launched new private equity funds, discretionary funds for commercial value added fund for China and Singapore, and also debt fund. And more recently, of course, this year, some of you commented that again we surprised the market by announcing the proposed merger between CCT and CMT. Again, the idea behind putting these two REITs together, I think, was already being clearly articulated. I don't want to spend time talking about it, but it revolves around the strategy and how we want to be competitive, not just in Singapore, but really becoming a more global player. To achieve the ROE and to make sure that we have a strong balance sheet, we take a very, very disciplined approach towards the way we manage our capital and the way we recycle our assets. And that really set the stage for us to make sure that we are ready to look at new opportunities and to continue to seek out, especially for good counter-cyclical opportunities that may come up, hopefully in the next couple of months. So that's all I want to say. I'll leave Andrew to go through the details of the results for you, and I leave more time for Q&A. I'm sure many of you have questions around COVID-19. I will say a few more words about that after Andrew's presentation, and we leave more to Q&A. Thanks.
Great, thanks, Chee Koon. Good morning to everyone. Thank you for making time to join us either in person or to dial in or to join us electronically. I will take you through our fiscal 19 results. I think what I'd like to demonstrate and build on top of what Chee Koon has mentioned is that the strength that you hopefully will take away from our financial results allows us to come and attack 2020 in a position of resilience, a position of being able to respond as needed to the unfolding situation linked to COVID-19, and also allowing us to react quickly if we have opportunities that allow us to grow the business strategically. So these are three, I think, important things to take away. But moving on to results. First, a bit of housekeeping. We are making two changes, one to our annual reporting. So we are moving to a semi-annual reporting cycle in conjunction with what SGX RegCo has allowed listed companies to do. Many of our REITs will follow suit concurrently. The other thing we are also doing is we will be valuing our investment properties on an annual basis at the end of each year, beginning with this year. Okay, let me take you through some of the key highlights. I think on a P&L basis, we delivered a very strong and credible set of financial results. Our PATMI grew by 21% to 2.1 billion. Most importantly, our operating PATMI is at an all-time record high. We passed 1 billion for the first time. This growth, I think, comes and is built upon the combination with ASB. What we've done here in this slide, when we show you the P&L numbers, is to give you the contribution from ASB, which is the grey box you see on the right-hand columns. So ASB contributed substantially to our performance. This was just a 6-month performance, we should remember that. But even without the ASB contribution, you can see that the CapitaLand portfolio on a standalone basis also delivered growth year on year, and that's an important takeaway. Fourth quarter was a very strong quarter. I think, again, building on what the ASB portfolio gave to us, both in PATMI terms and in operating PATMI terms, we almost doubled our operating and PATMI numbers. Sorry. This is a new slide on capital employed. those of you who were with us for strategy session late last year will know that we spent a lot of time talking about how we wish to deploy capital. And on the left-hand side, you will see our capital allocation priority, where we strive to achieve a balance between our developed and emerging markets. And we also set out for you our capital allocation targets for our 4 core markets, namely Singapore, China, India, and Vietnam. On the right-hand side, it shows you the progress in the journey we are taking. We have achieved a better balance in the way we employed our capital in 2019, but also shows that we have a ways to go in achieving that right calibration. Importantly, for 2019, on EBITDA terms, we also managed to deliver north of 50% from the developed markets in terms of EBITDA. So this is important for those of you who are watching us on the FTSE Nareit index. We also spent a lot of time in November talking about fund management and our fee income business. So this is an important slide for those of you who are watching that. We registered substantial growth, not only in our REITs and business trusts and funds side of things, so John's area of the business, but also in lodging, where we delivered strong year-on-year growth, which is the gray arrows, 56% for our fund management business and 13% for our lodging business in fee income earned for 2019. So this demonstrates to you, as Chee-Koon mentioned, that we are very focused on executing and delivering on our core targets. And one of them is indeed to grow our fund management and fee income side of the business. The other thing we were very focused on is capital recycling. It should come as no surprise to you. We were delighted to be able to almost double our target of 3 billion gross value, which we set for ourselves annually. We delivered 5.9 billion in gross divestment for 2019. The blue part of the pie chart shows you that most of the divestment went into our REITs and our funds, which tells you that we are recycling capital and we are releasing capital to CapitaLand for us to redeploy. But a lot of this capital that we are recycling is going into our offtake vehicles. So we are demonstrating strong sponsor offtake relationship. We are demonstrating that commitment to grow our funds under management. We are demonstrating the ability to grow fee income whilst we recycle capital. Fourth quarter was also a very active quarter for us, where we again cycled both core and non-core divestments. In terms of revaluation, here we show you the top 10 assets that contributed to that revaluation. Was roughly about 70% of the total reval number. Now, if you take the average, the NPI yield on valuation for these 10 assets increased from 4.8% to 5.2%. What we're trying to show you here is that this revaluation, fair value revaluation, is defensible and underpinned by NPI growth. This is a snapshot of our 3 profit buckets. You see that all 3 buckets delivered strong growth. Again, I focus you on the cash PATMI portion. Overall, cash PATMI is about 70% of total PATMI. The first 2 columns are our cash PATMI. Our operating, recurring, resilient income grew by about 160 million to north of $1 billion. Okay, that's an all-time high for CapitaLand Group. Again, underpinning the fact that we believe we are in a resilient position and a position of relative strength going into 2020. Portfolio gains give reflection of the higher capital recycling, the higher velocity at which we are recycling capital. Very proud to say that we have delivered a double-digit return on equity for 2019. This is the 3rd year that we have delivered a return on equity above our cost of equity. Again, you see that that return on equity is balanced. 70% of that is cash-based and is well distributed throughout the stack. And last but certainly not least, on our commitment to delever the balance sheet and get it ready for our targets and what we want to achieve in 2020 and going beyond. We said at the time we combined with Ascendus that we wanted to get our balance sheet back to 0.64 by the end of 2020. We managed to do that in 6 months, 1 full year ahead of schedule. We are at 0.63 as of December last year. It gives us this ability, this agility to remain resilient, to provide support if needed, but also to take counter-cyclical positions if and when we find the right opportunity. For example, in the announcement today, where we've just acquired a business park in the UK. I want to point you to the last bullet point there, where we've taken out the consolidation effect of our REITs that we consolidate. So with the consolidation on the balance sheet, we are 0.63x. If we take out the effect of the consolidated REITs, our net debt to equity is actually 0.56x. So I would submit to you that on a standalone basis, CapitaLand is actually in a better, more robust shape in terms of the balance sheet. And I think I'll end on this, where we have announced also that we are in an ability to announce 12 cents a share. We are maintaining our dividend from 2018. Now, this is an important decision by the board, by the management, in a show of prudence, and also to demonstrate that we have the ability to continue to pay a sustainable dividend to our shareholders, in concurrently with delivering strong total shareholder return, which shows that the market is accepting and is coming along with our message and how we are executing our business. Maybe I can pass this to CK to end off with what has happened this year and how we are dealing with it.
Actually, I alluded to it earlier. We started the year all very confident. We thought, again, we managed to catch the market by surprise by announcing the proposed merger of CCT and CMT. And then suddenly towards the end of January, the China suddenly announced the lockdown of Wuhan because of COVID. And ever since then, last few weeks, we've all been busy dealing with these issues. Of course, our business in China was definitely affected. Our malls, and more than 12 of our malls were closed. We immediately set up a BCP in China and subsequently in Singapore, to manage the issues. Priority then was to make sure that we look after the well-being of our staff, our colleagues, the tenants, our partners, and making sure that we work together as a company, together with our stakeholders, to make sure that we can ride through the journey. Throughout the whole of Chinese New Year, when everybody was, or at least I usually spend time holidaying, we were spending time trying to make sure that we get surgical masks for our colleagues in China, in Singapore, to help those on our front line. Also very quickly set up a Hope Foundation Fund in China to help to get surgical masks and medical supplies to the people who are helping out in the front line. Of course, in the last 2 to 3 weeks, we've also been talking to our retail tenants that were most affected by the COVID, both in China and in Singapore, to look at relief measures. Some of it we have been announced in the last few days in China. For those malls that have been asked to close, we gave a rental rebate during the periods of closure, so that we can help the tenants along. In Singapore, we also take a very targeted approach. First and foremost, of course, we committed to transfer whatever tax rebate, property tax rebate that the government has given to all the tenants. I mean, it's really just the proxy. We are passing that on to the tenants. On top of that, we're helping to relieve the security deposit 1 month to help them in terms of the cash flow, and on a targeted basis to help the most affected tenants, especially those in the downtown malls, on some amount of relief measures. My own view is this COVID crisis is going to be a temporary blip, not different from what we see in SARS and H1N1. Of course, I mean, I think all of you are probably experts on the COVID after having spent so many weeks reading about this. You know that it's highly infectious, but in terms of the fatality rate, it's actually quite low. I think we also have to applaud the Singapore government and also the Chinese government for taking pretty tough actions at the very beginning to make sure that, you know, it created a lot of inconvenience and fear at the very beginning. But I think today, things are starting to get back to normal. I'm happy to share with you that in Shanghai, in Guangzhou, there was massive traffic jam yesterday, meaning that activities are coming back to life. I think a lot of credit really goes to the Chinese government for taking very tough action to make sure that they contain the issue. Singapore, I think initially when the government raised the DORSCON alert from yellow to orange, that very weekend, we saw a very drastic drop in the shoppers' traffic in our malls. So, of course, our tenants were worried. Even we were concerned. But then subsequent weekend, things, I think the government did a lot of effort to allay the fears and the concerns, to communicate. And we started to see crowd going back to the malls. I go to I make it a point, together with a number of my senior colleagues, to eat at our malls, to spend time at our malls, to talk to the retail assistant, to talk to the shop owners, to understand the situation. So I know things, of course, not back to where we were at the very beginning, but in terms of foot traffic, I can, for most of the malls, the foot traffic has almost gone back to normal, especially the suburban malls. The difference today, Jason will give you more color later, it's probably in the region of about 5%, the drop of traffic. So I think it's a good sign. I think as a community, as a whole, although we are concerned about this COVID-19, we need to make sure that all of us need to do our part to get life back to normal as much as possible. The economy needs to go on. We need to spend. We need to live life so that, we don't want to have a situation where, when the COVID crisis is over, the economy goes into big problems. Because frankly speaking, as long as we are cautious, we are careful, we are vigilant, I think that as a whole community, we should be able to handle the COVID crisis. That's my own view. Okay, so that's that. I thought I should at least give some comments about this COVID crisis, because I'm sure, okay, I can expect that there'll be many questions around this issue. But rest assured, okay, I think as a company, our balance sheet is strong. What we are hoping to do is to make sure that we ride this through together with the stakeholders in our ecosystem, and we stand ready to continue to pursue growth for CapitaLand and to seek counter-cyclical investment opportunities. Okay, with that, I like to maybe proceed to the Q&A, where we can leave more time for all of you to ask more questions. It could be about the business, about the results, about the COVID. But I just want to maybe just end off by saying that whatever we achieve here in 2019, I think it's a good set of results. I just want to take the chance to thank all my colleagues for all the hard work. It was a very, very busy year for everybody last year. I also took the chance to tell them that although everybody, from the corporate right down to the colleagues at the front, everybody was busy. But that will be the new tempo that we will have for CapitaLand. We will continue to be very busy, looking for growth, driving the company to greater heights. Okay, so that's something that is something that everyone has to get used to. Because if we want to position ourselves to be a global company, to be a globally competitive company, that's par for the course. Okay, thanks.
Thank you, Chee Koon. Okay, may I invite the rest of the senior management team to join us at the front for Q&A? So in addition to Chi-Kun and Andrew, who have addressed us, we have Mr. Jonathan Yap, President CapitaLand Financial, Mr. Lucas Low, President China, and Mr. Jason Liao, President Singapore and International. So we will start with taking questions from the floor, and then we'll move on to our webcast audience. Anyone wants to take the first questions? Mervyn?
Hi, Mervyn from JP Morgan. Chi-Kun, congrats on that ROE. It's a fantastic result. I guess a bit more tricky this year, but maybe on COVID-19, I think you talked about rebates for the malls that are closed. Maybe update us in terms of malls that are not closed, whether you're giving half a month rebates, what's happening there. In terms of China Resi, are you seeing any impact? I guess we see Kevin here, maybe on the hotel side. Obviously, Singapore being deeply affected, but are you starting to see impact in terms of occupancy or ADRs, be that in Europe or Japan, Australia, and the like? Yeah.
Okay. Maybe as a backdrop, before I leave to the rest of them to give the details. Business definitely has been affected. Definitely, I mean, essentially nobody could go to the Resi show suite in China. I mean, the government has mandated that all the show suite has to be closed during the period where the tensions were high. So when you close the showroom, naturally, no transactions could take place. But happy to share with you, when the people started to go back to office last week, we started to sell residential and even car park lots. So activities are starting. I mean, that's a state of affair for China. People are starting to go to the malls because psychologically, people feel so pent up that actually people, when you allow them to go out from their house, actually people want to go to the parks, people want to go and spend time to shop, to live life again. Because human beings, at the very core, we are social creatures. I mean, just imagine if you've got colleagues who, when they go back to China now, especially in Shanghai and Beijing, they have to spend 14 days self-quarantine in their apartment. So when I speak to many of them on quite a regular basis, they say that, it's, for those who have started to go back to work, they say it's like, freedom from jail. So they never appreciated the kind of time that they have, to go to the malls, to appreciate life, to appreciate crowd. So fundamentally, I feel that in Singapore and China, the business recovery, the activity will go back to life a lot faster than most other places. For China, maybe I ask Lucas to give a bit more color, and then Jason, and then I ask Kevin to share more on the lodging side.
Like what Chi-Kun has said, I think for the number of malls, he mentioned that currently there's 12 malls that are still closed. Actually, these 12 malls, 4 of them are in Wuhan, who are still closed because the whole city is still locked down. 2 in Xi'an, 2 in Harbin, Raffles City, Chongqing, the mall is also closed. And also 1 in Hohhot, and 1 in Chengdu, and 1 in Changsha. So all these are under the instruction of the authority on the ground that we are not allowed to open the mall. So it's not like voluntarily we close the mall. So, but while the mall is closed, most of them allow the supermarket to be open. So as you can see, only the supermarket is functional to provide the daily necessity to the residents and all that. That's the situation. I think so far what we have announced in China is that for the Wuhan, we are providing a so-called rental waiver for a period from 25th to 13th. But of course, since then, the lockdown has prolonged beyond 13th. Why 13 was that was the period where they announced that to be the holiday period from 25th, which is the Chinese New Year, to the 13th. And for the rest of the mall, we have also announced that we will provide 50% kind of rental rebates for the period 25th of January to 9th of February, which is also the official holiday across China during that period. So I think we are still in discussion with the selective retailer across China with regard to other measures like what we have done in Singapore to see how to help them on the cash flow and all that. And of course, for some of the more, particularly those in the key city, we are also functioning on shorter operating hour in view of the lesser traffic. That's also a way to help the retailer to cut down on their operating costs. So most of the mall will close in the evening at 8 o'clock instead of the usual 10 o'clock. And that probably will allow perhaps only a one shift worker on the retail side to function for the mall. I think that's for the retail. Traffic-wise, certainly is impact because at the height of it, when Wuhan was locked down after the first week and all that, we see, in fact, during the New Year period or post-New Year period, compared to our normal New Year period, traffic has gone down to about 80 to even 90% in some of the mall. But gradually, I think as the measure in some of the city has eased, I think we see more traffic coming back and all the kind of things. We would say that probably the traffic has gone back up to about 40 to 50%. Still not back to the exact normal. Like what Chikun said, last few days, in fact, we see more traffic along the key city, Beijing, Shanghai, Guangzhou. People are still traveling and carpooling because they are still fearful on the subway and public buses as they progress back to work. So one observation is more car, less people on the buses, less people on the subway. Subway traffic probably about 20% of normal traffic, say Shanghai subway, main line that we see and all that. But car-wise, I think there are more passengers inside one car, as we can observe on the road, meaning that people are, I think, pulling together to go to work and all that kind of thing. As for residential, yes, during the January and February figure will be quite an awful figure because we are not open for business. So not that we don't want to sell, not that people don't want to buy. One is they cannot come out of the house. Two is that we are not allowed to open our sales center. But as we reopen most of our sales center on the 17th of February, we start to see people streaming in, look at our property, and we in fact close a number of our transactions with people wearing masks, not shaking hands and all that, yet transaction can be done. So I think that's also a reflection of the real demand of some of the residential building and also our shops and car parks that we managed to sell off. So for China, we would progressively see that life will go back to normal. And as our mall is more catered to the local demand, so-called, in most of the city, either is it the immediate community for most of our mall, or in fact for the Raffles City will be more for the city traffic and all that kind of thing. So we would expect when life go back to normal, when people are allowed to go back to the street, and people are allowed to so-called roam more freely, we will expect the shopper traffic to bounce back more quickly. Because I think less will be dependent on, say, foreign traveler going to China and all that kind of thing. So I think that will speak well for our so-called retail business in China. As for the offices and business park, we have started reopen on the 17th. Most of the company has reopened. I would say that the company back to business amount to probably about 70%. But we see the number of staff going back, maybe it's only half their strength. I think most of the company, likewise for us in China, we have also adopted a contingency plans, dividing into Team A and Team B. So not surprised to see probably half the strength in every of the office building that we run, that we don't see the normal number of staff going back to work for most of the company. In fact, we ourselves only have half our strength in any of the single office building, and we spread our staff to other locations as part of the contingency planning and all that kind of thing. So that's the current situation that we see on the ground. Yes. Yeah.
So I think for Singapore, I think it's definitely less affected. I think when Singapore first reported the first few cases, I think people were a lot more nervous. It doesn't help that, social media start to show ambulance going to certain building, carry people out in a very enclosed environment. I think that was the fear and anxiety there. But today, we reported about 90 cases. I think the Singaporean community, I would say, is a lot more confident that everything is under control. So that also gets reflected in our numbers. When DORSCON Orange was announced on the 7th of February, our traffic dropped actually by 15% on the portfolio basis. 2 weekends later, of course, you have the Valentine's Day, which I think a lot of you couldn't find tables. And then the last weekend, 22nd of February, we have seen foot traffic actually gone up again to less than 5% pre-COVID-19. So it's actually gone back quite well. In terms of GTO sales, we have also been monitoring. The January numbers seems healthy. It has not dropped from year on year. We are also monitoring the February numbers now, and we can come back to you. We have not seen the full detail. In terms of arrears, we also don't see any spike in arrears. So our tenants are actually still paying rent and doing well. So we will continue to monitor this, but all in all, I will say our portfolio is a very resilient one, especially the suburban malls. Continues to attract a lot of traffic and footfall.
I'm just going to pass the time to Kevin soon. I just want to recognize this question that came through webcast. It's from Kevin Lim, Nikkei News Rise. He asked, traffic at the malls may be recovering, but what about hotel bookings? Can you provide some color about CapitaLand's hotel and service residents? So I think Kevin can provide more color here.
I'll give some background. On the lodging side, I think we are affected, but I think it's mitigated by two factors. One, our length of stay is generally longer. So we work on a predominantly long stay model. And the other is that most of our travel, 80% of our travel are corporate travel. So you will see that the elasticity of demand is actually a lot tighter than the leisure market. Right? So to that note, I'll give you a flavor of how our occupancies are doing globally. Starting with the source, which is China, where it all started. For China, if you look at the first tier cities, which is Beijing, Guangzhou, Beijing, Shanghai, Shenzhen, Guangzhou, we are currently running about 70% occupancy, right? Across China, including the second tier cities, our average is about 40% occupancy. Now, depending on which report you read, some says that hotels have shut down in order to save costs. Some are doing maybe 5%, 10%, 15%. So in relative terms, yes, we are affected, but I think in relative terms, we are slightly less affected than the hotel industry as a whole. So that's China, and I think in China, we have also done a lot to help our residents. We actually implemented this robot delivery about 2 years ago, and it comes in very handy now because we can deliver anything that our guests want without physical interaction. So that has worked very well for us. We have worked with our consulate officers in China across different cities to help the residents with evacuation should they want to leave the city and go back to their home country. So these are opportunities for us to build a bond with the residents, especially our long stay residents, and that will help our business in the longer run. Then we come back to Singapore. Generally in Singapore, if you look at our escorts in Orchard, in Raffles City, we're still running at about 70% occupancy. Again, really because we are on a longer stay model and we are on corporate demand, right? So leisure demand, I know a lot has dropped off. If you ask around us for Singapore hotel occupancies, again, there's a range. I think it probably is around 20 to 30% kind of number. And if you look at Southeast Asia as a whole, I think last year compared to this year, occupancies have dropped off about 5 percentage points. Right? So I am hopeful that the impact is mitigated, and I do hope that things will come back because a lot of corporate travel, needs to happen, and I hope that there's a recovery that will come through after this whole episode kind of calm down and is over. There was also a reference to Europe and US. I think I just called up my US and Europe colleague last night. I think generally speaking, life, or at least our bookings, is as per normal in Europe and US. So to the extent in the Western world, I think we are less affected at this point in time. Right? So I hope that gives a good flavor of the situation on the ground now.
Thank you, Kevin. We'll take a couple more questions from the floor before we move on to our virtual audience, actually hitting 180 today, so quite a full hall virtually. Okay, next question here. Yep, please. Sorry, we'll pass you a mic.
Faris from Bloomberg. I have two questions. The first is, what's your forecast for earnings in the first quarter? Like, how much do you expect earnings to take a hit? If you can give us a ballpark figure. And the second question is with regard to the wage measures. It comes after Temasek also announced similar wage measures, and after that, Singapore Airlines also did the same, and Temasek is majority shareholder. And I do wonder whether is this a directive from Temasek?
Let me answer the second question first. Actually, immediately after our Chinese New Year, we had a session amongst the senior colleagues. I've already told the senior colleagues that we will be taking a pay cut from 5 to 15% and do a wage freeze. So that was sometime 2-3 weeks ago. It's just that we didn't think it was appropriate to send a message at that point in time. We think it's better to do it during the full year results. Otherwise, we send a signal, people will think that is our results going to be severely impacted. So that was really the consideration. So we thought, show a good set of results, strong balance sheet, then we tell you that the pay cut is not because we are trying to conserve cash. The idea is really we are doing this because our stakeholders, meaning our tenants, we have people who are affected. In fact, we have a colleague in Wuhan who has passed away because we suspect it's because of the COVID, because when he tried to get medical help in the hospital, he couldn't get admitted. Nobody could treat him. We couldn't even confirm whether it's the case. So we believe there's a show of solidarity with our stakeholders. We decided that's the right thing to do. So that's point number 2. In terms of the earnings, I think it's too preliminary to say at this point in time, because if you look at our business, we have very strong cash flow coming through our investment properties portfolio, and even if you sell your residential units, you can't really recognize it until the handover period. So I wouldn't. I think it's too early to give us that guidance at this point in time. And typically, we don't give guidance in terms of earnings, anyway. Yeah.
Okay, we have Donald.
Hi, Donald from Bank of America. Quick question on your recycling target for this year. Any changes given COVID-19? And looking at the breakdown of your earnings this year, close to 50% is from portfolio gains and revaluation gains. How's the management's confidence in maintaining this run rate going for 2020? Thank you.
Thanks, Donald. No change. If you look at our asset base, post-ASB acquisition, total consolidated assets about 82 billion. So if you put that in context of our 3 billion annual gross value target, I think we still remain confident that we can continue to recycle. Obviously, the caveat is let's see how long we take to emerge from this situation, right? So currently, we believe that it's a short but relatively contained period of uncertainty. If we get back to a business as usual and the normalization of the operating environment, then I think we retain that confidence. Similarly, on the components of our return on equity, that remains unchanged at this point in time.
Sorry, maybe I just add on to Andrew, then you can. I mean, the thing to remind maybe the audience is that we do have very strong platforms, especially our REIT platforms. I mean, they are trading at this point in time still quite strongly, and they definitely offer very. I mean, there are platforms for us to continue to acquire assets or to recycle assets from the sponsor all the way to the REITs. So this is something that we will continue to look at, and of course on the funds angle as well. There's still a lot of capital out there trying to look for good opportunities, and I'm dare say that most of the assets on our balance sheet are well located, good assets, and we have a strong boots on the ground, strong operating capabilities, and I think that we should stand on the position relative strength-wise, we should stand in a much better state than other people.
Sorry, on that point, is there anything that we should be looking out for 2020, be it redevelopments or asset injections into REITs or divestments of non-core assets? Is there anything that the market should be looking out for 2020 for CapitaLand?
Definitely. It's just that when we'll announce when it's ready. We have mentioned earlier. Singapore, it's about rejuvenation. So hopefully, in the due course, you will see more rejuvenation type of story. I think early this year, just a few weeks ago, we talked about Bugis. We got Bugis Village, and the reason why we got Bugis Village is we believe that that's an interesting place where we could rejuvenate, understanding that we have two very dominant assets next to Bugis Village. You get it right, you drive the traffic for, I think will help to further drive traffic to the two malls that we have, and will help to drive the business further. Similarly, you see what Jason's team has done on the Liang Court side through rejuvenation. And hopefully we will have more stories to share on the rejuvenation for Singapore. The assets are all in good locations, sitting on top of train station, where you understand from the Singapore government's point of view, they want to continue to urbanize, to intensify the land use, creating opportunities. I think these are interesting dialogue and ideas that if we have, I think these are interesting opportunities that we should continue to pursue. That's on the Singapore side of things.
Yeah, the word used earlier was tempo, and I think that's very appropriate. We've set a tempo with our activity and our ability to execute in 2019. We have an absolute desire and commitment to continue on that tempo. So if the operating environment allows us to do so, then you absolutely should expect more from CapitaLand.
Wi-Fi.
Thanks for taking my questions, Wi-Fi from UBS. I have three questions. Firstly, congrats on achieving your net gearing target earlier than expected. Just wondering whether this is at the level that you want to keep, or do you think there's more headroom given your changing portfolio composition? And secondly, in Singapore, you're merging CCT and CMT to undertake your integrated developments. Just wondering whether you have the same plans for China, since some of your mixed developments still sitting on your balance sheet. And thirdly, since you mentioned Liang Court, have you ever considered a joint rejuvenation with Clarke Quay? If yes, what was the hurdle besides the fact that it's a conservation site?
Thanks. I'll take the first question on gearing. So I think we've previously talked about a sweet spot of 0.6 to 0.7x. So consolidated wise, we're in the sweet spot. If I take out the REITs, we're actually at 0.56. So again, it goes back to putting ourselves in a position of strength, of relative strength, and the ability to be opportunistic, take counter-cyclical positions. So we are here now. We're today at 0.63. We can potentially recycle further, get that gearing even down lower. But also equally, if we see the right opportunity, we have the ability to take a sizable position. And you all know that in periods such as this, you also get very interesting opportunities. So we want to be very sure and very clear that we are in position to do so.
Just to maybe just add on to Andrew's point, the Ascendas Bridge merger itself, the enterprise value of the transaction was an 11 billion transaction. I think it was the biggest deal that CapitaLand has done. I think we executed it quite well, and I think that that's also set the stage for the team. That we are ready to take on big deals if we are quite confident in our ability to execute. So I just want to set the stage, and so we are definitely be on the lookout to look for very interesting deals that can make strategic shifts and to position the company in a position of strength.
On the integrated development, actually for the integrated development in China, mainly are the Raffles City. In fact, most of them are in the various private equity fund. Of course, with us having a stake in there, with the exception of Raffles City Chongqing. Of course, after the merger, in fact, we end up owning almost the whole of Raffles City, Chongqing, which we are. In fact, the whole portfolio, we are looking into the various possibility all along, where the market allow, where the jurisdiction allow, and all that kind. So whether it's a capital market action or whether it remain as a private equity fund and all that, these are all the possibility going forward that we would explore going forward. So of course, looking at the current moment, our stake in the various Raffles City, I mean, we could probably look into reducing some of the holding in some of the portfolio, but as a whole, we will look into the various possibilities where the market allow us to do it and all that kind of things. Yeah.
Jason, you.
Yeah. So on Clarke Quay, if the question is whether we will redevelop Clarke Quay, I don't think we have an immediate plan. But in looking at the redevelopment of the Liang Court, we definitely have the intention to integrate the development together with Clarke Quay, whether it's through the river promenade or whether it's through the retail podium. We definitely want to consider this as part of the standard Clarke Quay precinct. So that is the plan currently.
Would you get extra GFA as a result?
I think the development is on a standalone basis. Yeah, so if there's any connection, then I think we got to apply to URA and get any additional GFA if there's a plan. Yeah.
Okay, so that is eligible for STI scheme.
No, that is not.
If you connect the both, no.
It should not. Addition.
Okay.
Yeah.
So I'll go to a question from the webcast. Listen from Business Times. We received a few questions from you. We'll just take the one on the counter-cyclical acquisitions. We've mentioned quite a lot of that, but what exactly do you mean by counter-cyclical? Maybe you can elaborate more.
Well, I mean, I can only say that we are always on the constant lookout for deals. So, I mean, especially if there are interesting opportunities that can really help to shape our portfolio or to strengthen our competitive advantage. At this point, it's too early to tell. So when we are ready, we'll share the details. Yeah.
Thank you. I think we had a question. Derek? Sorry, Louis. Sorry.
Louis from Credit Suisse. Two questions from me. I think the first is on dividends. Very strong set of results. Your earnings, both on a headline and operating basis, up more than 20%, but the dividends have been maintained over the last 2-3 years. So maybe you can, I know it's about prudence, but maybe you can share more thought process about that. And also earlier, I think Chee Koon, you alluded to potentially thinking about a special dividend. Is that still on the cards given the environment? That's the first question. And maybe the second question, in relation to your capital allocation, close to about half of it was in China in 2019. So in terms of asset class and geographies, how should we be thinking about it, particularly given the counter-cyclical, you mentioned it a couple of times?
On dividend, I think somebody asked me during one of the investor session whether there will be a special dividend. I just jokingly say, yeah, we could give ice cream. That's all I said. I didn't mention about giving any special dividend. I wanted to clarify that point. But maybe on the dividend, I mean, the thinking behind this is, I mean, the COVID, we have a strong set of results, strong balance sheet. If you ask me, I mean, of course, from the investor's point of view, many people would think that we should have the ability to increase our dividend. That's not a wrong perspective. The current issue that's confronting not just CapitaLand, Singapore, but the rest of the world is the COVID-19 crisis that is unfolding, and the extent and the duration of it is something that's still a question mark. So it's really against this backdrop that we decided to be more prudent, more conservative, and that's why we decided to, of course, with the approval from the board, to take a more prudent approach to maintain the level of dividend. So that's really the thinking behind that dividend amount. Yeah. Sorry, the other question was? Deployment of capital. Put it this, for instance, if China, there are interesting, good opportunities in tier 1 cities that comes up because of this COVID situation, will we take opportunity? Yes, we will, even if we are going to adjust the capital allocation, because good opportunities are difficult to come by. So it really depends on opportunities. But honestly speaking, China is a country with strength, and there are many policy measures that the Chinese government can do. The issue is whether can you really find good counter-cyclical type of opportunities in China or not. That's a big question mark. But I want to assure you that we are definitely looking. Our basis of looking for any opportunity, we need to be sure that it can help us to achieve that level of returns, again strengthen our level of competitiveness. So that's how we look at any type of counter-cyclical opportunities.
If I may just add to that. So when you look at capital, it's again short-term, long-term. Capital is about planting seeds, and we've repeatedly committed to being very constructive on China long-term. We still think China is going to be a core market for us, and we remain very committed to China. So if you think about from a timing perspective, when is the best time to plant the seed to reap something in the future? Is actually when prices are cheap and you take a counter-cyclical position with the belief that you obtain a disproportionate benefit down the road. So we stick to that view. The other thing I would like to add is that China has actually effectively recycled its capital very well in 2019. So while the proportion is still sort of higher than where we would like, it has actually come down on a year-on-year basis, which tells us that the capital recycling efforts from China are actually taking hold, and it's able to sort of continue to self-fund its growth without coming to CapitaLand Group for additional capital. So these are two very positive signs that we see with our China business.
Maybe I'll just make a general comment. There are quite a few questions on whether it's counter-cyclical or whatsoever. We talk about quite a few things about creating tempo. So one of the key focus when the group got together early last year was to basically work out how can we get ourselves into a position to be ready to leverage on opportunities. We are a long-term investor. So are many of our capital partners. They are also long-term investor. So clearly we want to make sure that while we keep our eyes very close on delivering the targets that our shareholders want us to deliver, we also want to make sure that we are constantly in the market to leverage on positions when they come about. So as you can see, even during this period, there are still investors out there making investments, and even ourselves, we just announced a deal in UK this morning. I think at the end of the day, whether you call it counter-cyclical, whether you call it, is in the market, it is all about making sure that we stay financially disciplined to do the right deals. And in order for us to do that, we need to make sure that we're in the right setup to do it, make sure we have the firepower to do it. And that's the reason why we took a lot of time last year to focus on getting our fund management structure in the right shape. From the ART-AHT combination to create what is Asia-Pac's largest hospitality REIT, to the announced intention to merge CMT and CCT to put ourselves in a very strong leadership position to be able to leverage on the growth opportunities and build resilience in the vehicle so that we can more effectively participate in the integrated commercial sector. All these are efforts that will continue to do to make sure our fund management structure is appropriately done. Obviously, on the private side, we have constant conversations with our many private capital partners. Likewise, we are very like-minded. We want to look at opportunities. When the opportunities are right, we are ready to act, but we are not under any pressure to do deals for making deals sake. I think at the end of the day, we owe it to our shareholders to make sure we do what is right by them. We also owe it to our various stakeholders to do what is right by them. So clearly now in the situation of COVID-19, we need to get past the situation, but rain or shine, I guess life goes on. We still need to make sure that we continue to keep our eyes on what is coming ahead of us while we deal with the short-term challenges. Thank you.
Have the gentleman in. Okay, sorry, we'll go with Wilson first. Yeah.
Hi, good morning. Wilson from Morgan Stanley. Just 3 questions for me. So you just mentioned the REIT, so maybe I'll start with that first. With the merger of CT and CCT into CICT, that could potentially be the 3rd largest REIT in Asia Pac. Would number 3 be good enough? How big do you aspire REIT to be? That's the first question. Second is on Vietnam. So Vietnam, there has been a slowdown in sales in 2019. What's your outlook for launches and sales in this year, 2020? Lastly, just on semi-annual reporting, I'm not sure if I missed this earlier, but what drove the decision to go to semi-annual, and why the difference across some of the different REITs? Thanks.
I suppose to do in a sequence. The danger with numbers, obviously, whether it's good enough. I guess rather than focus on absolute position in the market, the focus is making sure that we're constantly growing. Even when we end up with number one, doesn't mean that we're going to sit there and be happy with it. We'll still want constantly to grow. But I would stress we want to grow in a very financially disciplined manner. So the whole reason why we go through all this efforts in making this is to make sure that we are in the ability to have a structure that makes sense, that allow us to grow. So clearly we will not do all that and just sit there and be content with it. So we'll push ourselves very hard to make sure we constantly grow.
So just on Vietnam, just a clarification, our sell-through rate is about 98%. And the reason why the 2019 sales number is low is not because of the market, but because we have a very weak pipeline. And that is not just CapitaLand, but across the whole market, because there has been a lot of anti-corruption measures. So approvals are actually being delayed. We have about 2,200 units with a gross market value of about 750 million Sing. That has been sold, and this will be recognized progressively over the next 2.5 years. So the sell-through rate is good. The embedded profit is there. So I think it's a question of getting more land and developing more and sell. I think the market remains very strong and resilient even in this period.
Last question on SAR. So I think the principal reason we elected to move to semi-annual is the desire to align with the view that we want to move away from focusing too much on short term. And we believe that by extending it to a semi-annual basis, that at least promotes the view that we are focusing towards sustainable earnings, sustainable growth, and so on and so forth. So we like the direction that RegCo has come out with. I think many of the larger corporates have followed suit. We also took the time to speak to many of our shareholders and ask them what would you prefer, and if there was going to be a big difference in your outlook if we moved to a semi-annual. And we were encouraged by the fact that majority of the respondents actually told us it doesn't make a difference to me whether you are on QR or SAR. But what's important is that you keep us informed and you stay engaged. And so this regime of continuous disclosure, I think actually is very sensible. As long as we feel that there's something that we should be telling our shareholders, we don't have to wait till every quarter. We can just come out and tell you. So long as we tell you that this is important to us, it has a material impact, and we stay engaged with our shareholders. So actually, we think we like this approach. I think you also had a question around whether the REITs would follow suit. I think most of our REITs are also switching to semi-annual, with the exception of the two REITs that are currently involved in the merger. They will stay status quo for now.
Clearly, because it's in the middle of transaction, we want to make sure that we give all the necessary information that unit holders need to make the decision. So it's just purely that.
So we have a gentleman in red.
Hi, Bolong from Zhangpao. So just now you mentioned, Chikun, just now you mentioned about like this COVID-19 will be a temporary issues that. Is there a time frame, like how long you expect the activities to go back to normal, like say Q3 or Q4 this year? And then is there any provisions made if the crisis is longer than expected? And then the other question is about this rejuvenation stories that you mentioned earlier on, that say for example Bugis areas. So are you looking at, say, sites like Kampong Bugis and also like Greater Southern Waterfront, which have a lot of rejuvenation stories in there?
On the COVID-19, I think too early to tell. I mean, we work on a base case where things will get back to normal in a 3 to 6 month week. My own sense is by the time summer is here, I mean, I'm not a medical expert, based on what I read, I think by the time the summer is here, things should be much better. Already we are seeing signs of activity in Singapore. I mean, the important thing is for Singapore, we need people to, apart from domestic consumption, we still need to get people to come back to Singapore. That will drive the growth. I think on China itself, which is our next, our single biggest market. If you look at the shape of the economy, China's domestic economy is actually very, very strong. 60% of the GDP is driven through its own domestic consumption. So as long as the China side recovers and contain, I think we'll see a sharper bounce back. You look at the Chinese, at least if you take reference from what the Chinese government has said that they wanted to do, is that they project that this year they will maintain the same level of economic growth that they had set out to do. So I think it could be quite interesting to see the kind of measures that the Chinese government would do, and how the different businesses, and especially for a player like us, would hope, how do we position ourselves and to be able to make sure that we are part of this, make sure that we don't lose out in terms of what the government is trying to do on that front. On the Singapore side, Jason can give more details. The thing is, today, after the merger with Ascender Singbridge, we have more than 100 properties in Singapore, and many of our portfolio actually sit on top of very good train locations, and we can look at the pristine type of rejuvenation opportunities. That's why we look at Liang Court, we look at Bugis. There are other things that we are looking at. So it creates a lot of opportunities. If there are land tender that's coming up, if the land pricing, land tender in Singapore is extremely transparent and bringing competition from anywhere. So the issue is, if you're going to participate, you want to make sure that you can win the land at good pricing and you can create value. And there are other things of looking at. Sometimes by looking at our own portfolio, there are many things that you can do to rejuvenate and create opportunity, rather than to compete in land tender when there is so much capital chasing very few assets. So we have to be very clear. Again, it goes back to our central theme of our business model, where we really want to focus on value. How do you find value? How do you create value? And how do you unlock value? So it goes back to the same business model that we are talking about. Jason?
So if the question is whether we'll look at Kampong Bugis and South Avenue, we'll look at everything, but I would say that the value creation is the most available to us when we look internally within our portfolio, given the government intention to intensify some of the plot ratio. And with all these schemes, whether it's SDI or the other schemes, I think we are definitely looking at our own portfolio and also looking out externally whether there will be value in there. Yeah.
So on this topic, we do have a question from Derek from Macquarie. I think his question is more targeted at, given that we've talked about so many rejuvenation ideas, do we have any thoughts about how we would prioritize these various things that we've talked about?
We definitely have a view internally, and we would announce them progressively. I think we have already announced Liang Court rejuvenation. We have already talked about Bugis, and I think there are several others that we are working on. I think at the appropriate time, we will definitely make the announcement. Yeah.
Give Jason a bit of time to keep a bit of trade secret.
Thank you. Okay. Sorry, we have a question from Tan Xuan.
Hi, this is Tan Xuan from CLSA. Firstly, my question is on retail measures. Can you help to quantify the total measures put in place for both Singapore and China? And would you also be able to share with us how are you going to split that between CapitaLand and the various REITs?
So for Singapore, we have announced two things. I think one is a marketing assistance package of 10 million. I think that will come primarily from some of our existing MarCom activities, budget and all that. So that will not hit the NPI. If you're concerned about whether there will be an impact to the return, that should not. We have also announced that we are prepared to give very targeted approach of up to one time, half a month rental relief. That will have some impact to the NPI. So if you look at half a month against, this is on an entire portfolio basis. So depending on the severity and the assistance required, we would dish this out on a very, very targeted approach. But like I say, when we look at the GTO numbers and the traffic count coming back to our malls, we may not necessarily see that kind of challenges that maybe the other F&B operators in other parts of Singapore are seeing. So we'll continue to monitor that, and on a selected basis, we'll then work with the tenants to make sure that they can ride through this period with us. Yeah.
I think as for the China side, just to put things in perspective, actually the 4 malls in Wuhan, actually the 1 month rental is only about 40 million RMB, which is about 8 million Sing. So based on the measure that we have announced, we are still working out, because the whole portfolio is owned through the various funds as well as the different ownership structure. I think the overall things probably slightly north of 100 million RMB that we are looking at in terms of the rebate and waiver to be given. But we are also in a different stage of negotiation with the different retailer at it. And of course, based on what I mentioned earlier on, the full sum would not be the overall impact just on CL itself, but will be among the different capital partner we have as well at this moment. So that's just to put some number in perspective.
I mean, the impact on from COVID on the businesses, especially the retail side, is real. I mean, we cannot just pretend that nothing is happening. So whether the impact on them, on their employees, and then of course, I mean, I believe that as a responsible corporate player, we need to make sure that again we share in how to, and especially how we can help them to alleviate this difficulty. I mean, fundamentally, CapitaLand believes that we are in this for the long haul. We are building business. We are not just here, just to squeeze every single cent out of our partner, because we think that during a period where we are going through difficulty, you can journey this together. You build a longer-term, sustainable portfolio. When we do some of these issues, we reach out to the tenants. We proactively, together with the help of the Singapore government, also reach out to the retail association, understand their difficulties, because we fundamentally believe you help the people through going through this journey together. Subsequently, when the business bounce back, they upgrade their capabilities and they have new concepts. I think, we will be good natural partners for them to work with. So we should be ready to take on the rebounds and to think of the longer term. How do we, again, through this period, journeying through with our stakeholders, with our partners, to strengthen our portfolio for longer term, long-term sustainable growth? That's what we are positioning for.
Can you also talk a bit about Jewel, the 50% rent rebate? How long is it given and which tenants have received it? And also, is there any other malls that you think will need such drastic measures? Thank you.
So Jewel, just to give an idea, because it's in the airport environment, so it's definitely more affected by the tourist arrival than the other downtown malls that we have. So what we have done for Jewel is to give a half a month rental rebate for 2 months, starting from I think March and April, for two months. So I think the tenants are very appreciative, and this is given across the board because of the unique airport environment that they are in. So we are, in addition to that, we are also putting in place free parking redemption, and then you have we are also opening out the canopy park, so that more people can enjoy the Jewel at this period of time. So it's not just about rental rebate; it's also about encouraging people to go back to public spaces.
But the fundamental thing is, Singapore has a finite population. So, you can only move around your 5 million people from this place to the other place. I think the Singapore government, I want to emphasize, is that they've done a great job in, managing the issue. I think we are starting to see business people coming back to Singapore. I think that's a very, very good sign. I think they come to Singapore, they feel comforted, they think they feel safe. They know that activities can proceed. And I think once this situation is under control, getting back into the travelers coming back to Singapore, business activity resuming. I think to me that's most important. And all of us here must play a part. Please also encourage all your family members. Okay, please go out. Okay, just be vigilant. Wash your hands. Don't rub your eyes. I think if all of us play our part, we can help build a very resilient economy, at least for Singapore. Okay, so that's something that if anything that I want to leave with you all at the end of this thing, let us all do our part, because we need the Singapore economy to be strong. Okay.
We have a question about the acquisition of the business park in UK that we announced this morning from Andy Wong, Bank of Singapore. I think I'll invite Gerald Yong, our CEO of CLI, CapitaLand International, to take this question. So maybe Gerald can give an overview of the acquisition. I think that's
Sure. Thank you. Thanks, Grace. Right now it's 77% occupancy. The entry yield is like mid-fours, mid to slightly above mid-fours, because of the current vacancies. The current vacancies are actually just newly refurbished, so they are well positioned to fetch good rents. We should climb close to 90% by end of this year, barring unforeseen circumstances. We expect it to stabilize in 2021, and by then we should hit around 7% net yield. That is our projections right now. In terms of development platform, probably not in the short term. We have right now in UK hospitality assets through Ascot. We have logistics assets through A-REIT. This is on our balance sheet right now. So collectively, the portfolio in UK that we are managing for CL Group obviously has grown. That enhanced strongly our asset management capabilities. We are doing some very small scale renovations, and we're actually redeveloping a small logistics asset under A-REIT right now, a pretty small one, like maybe about £10 million. So that one we're doing it ourselves. That's on the logistics front. For business park and office assets in general, not yet. But we are building up our development capabilities in a very small way under the assets that we own right now. Like no different from rejuvenating the Singapore assets. We are rejuvenating some of the logistics assets under A-REIT. Yeah.
Thank you, Gerald. Okay, we'll take last two questions from the floor or from the webcast. Anybody? Or Mervyn? JP?
Yeah, sorry, just got a few questions. In terms of multifamily, the US portfolio, maybe some updates in terms of progress, in terms of whether AER is nearly completed, uplift in ADRs, occupancies. I guess the other question I have in terms of India, I guess you have a 10% capital allocation, but currently it's minimal in the pie chart. Any progress there? On the lodging side, I guess fee income is important. Maybe updates in terms of number of contracts you've been signing and in terms of targets. And in terms of revaluation gains, you believe is sustainable going forward. Maybe to give us some confidence, what is the cap rates for the industrial portfolio in Singapore, China retail mall, and maybe ION, to give us a sense how conservative it is at this point in time. Thanks.
We'll take the first question on multifamily. Gerald will take that.
Yeah, very glad to. USA, when we acquired it at the time, we are talking about doing light value add. So the renovation of the common areas in the multifamily apartments and the interior apartments, we actually did it on our own largely. Of course, we have outsourced service providers to help us, but I'm proud to say that we've executed well. Of course, there was some minor delay due to seasonal factors. But by and large, for whatever we renovated, we actually achieved a payback of 5 years, which is basically what we have underwritten for those renovated units. So demand is strong. There's some weakness in Denver, but otherwise, overall, in other markets, they're very strong. I'm sure you have heard of rent controls being announced in California and Seattle, but the rent control caps are so high in terms of our actual rent reversions, we are well below that cap. So overall, we are on track. Yeah. So we are obviously, as we improved the asset position through renovations, we will consider options in time to come.
Jonathan, on India.
Mervyn, your question on India. You're right that currently our capital allocated to India is relatively low at 3%. partially also because we have very effective capital structure for our India business. The Ascendas India Trust obviously take up a fair bit of our investments in India that allow us to partake in the market in a very capital efficient manner. And we do obviously have big targets to grow in India, and that's the reason why we shared that we do want to set aside capital for India moving forward to that tune that you saw earlier. Having said that, that's something we will push very hard, but it also depends on how the rest of the world grow. And fundamentally, we're here to make sure that we make good investments that enrich our shareholders. So clearly, we'll be guided by opportunities, while we are also guided by the strategy we pushed ahead.
And there was a question on valuation. Was it? Lodging.
I think for lodging, we did very well last year. We signed about 14 to 15,000 new keys, and we opened about 8,000 hotel rooms. So out of the portfolio, about 115,000 keys we have right now. About 60% is operational, 40% is in various stages of development. So we've planted the seeds, the nursery is there, and definitely over time, more will become operational and more fee income will flow through. I mean, just to give you a sense, we average about $2,500 per key. So every 10,000 units we open, it will be about 25 million in fees. Right? So as we open more, as we sign more every year, more and more fee income will flow through. So it's just a matter of time for the business to grow and for the fee income to grow.
If you want a specific number on cap rates, Mervyn, maybe we'll take this offline. I'll come to you and we'll discuss it later. Thanks.
We'll respond to one last question from Damon Wang. Hello, Damon. I'm from LaSalle. Damon asked, what's the reason for the flat DPS despite asset disposal was above the initial target in full year 2019? And what are our thoughts on share buyback?
Okay, so I think we addressed the first question. This was, again, a measure of prudence, but also an important signal we wanted to send. On share buyback, it's always there for us, but I think that, again, this is the wrong time to be contemplating a share buyback. We want to have the capital ready to deploy, whether it is in response to a prolonged situation or in response to an opportunistic situation that comes our way. And that's, I think, where we want to be right now.
Thank you, Andrew. I think that brings us to the end of this session. Thank you so much for coming, people here, and thanks to our audience for dialing in. Any more questions? I know we can't take all of your questions. Please feel free to email us, and we'll keep in touch. Thank you for dialing in. Have a good day, everybody.